I'm with NAREIM, so I'm CEO of NAREIM, and this is really an association for real estate investment managers focused on the operational and management strategies. Our members represent 1.7 trillion of AUM. So I'm speaking to a lot of them, and there's a lot of uncertainty. There's a lot of excitement about some of the opportunities, but uncertainty politically, where we are in the cycle, that lovely phrase, that lovely question we all love answering, return expectations. They have really compressed over the last few years. And yet underlying all of that is the knowledge and the certainty that actually fundamentals are pretty good at the minute for commercial real estate. That's not out of whack. You know, there's a lot of appetite from institutional investors. You know, supply and demand is generally on track. There's obviously pockets to keep an eye on. But we are staring at the precipice of the next recession. What are we doing about that? How do we prepare for that? And I want to really dig into investor perspectives, what you're talking to investors about. We're talking, you know, that appetite, that capital flow. So obviously most of the panel have been very quickly introduced, so I'll very quickly go down the line. Obviously David Hodeswile, you're obviously capital raising. Just give us a very quick description of how much capital you've raised in the last couple of years.
It's somewhere in the $2.5 billion range. We kind of calculate differently. We tend to focus on what capital did we raise that somebody actually paid us to raise for them, as opposed to we did this little piece of a giant fund. But it's been on balance $2 to $2.5 billion a year, which is fairly consistent. I would say that it has the composition of the capital is very different. And you know, the reference point earlier about investors are indirect investing still. It's just the vehicles have become, I hate the word, but I'll use it anyway, bespoke, because that usually means a 12-month documentation process, as opposed to the somewhat less painful 6-month fundraise process.
Obviously, Alexander, Bob, and Guillaume, we've obviously had introductions from yourself, so Adria, I'd love to have a quick introduction from yourself.
Yes, Adriana, new in real estate, so I'm a portfolio manager for a core fund, daily and net asset value fund. So in the last 2 years, I've raised 1.5 million to invest in the US across all sectors, and now we're raising a New York City property fund, value-add fund. That's why I asked you about the US.
And that's something I do want to pick up on, because you've all repeatedly stressed about the value add and that window of opportunity for value add. But David, just to follow on from your kind of conversations with investors and obviously your report, what are the key trends that you have seen in 2018? And as you look to make predictions in 2019, what's the most important thing that we need to be talking about today?
Single most important thing? Oh, transparency. It's hard to narrow it down to single most important. I think that there continues to be a pretty wide range of what investors are prepared to do. It's just, you know, how deep is the vein of capital for highly opportunistic platform transactions? I'd say there's money out there for it, but not a lot. What's the deepest vein? Won't be, you know, a surprise to anyone. Things demographically driven, and it can be as simple as, you know, regular way apartments and housing, given, you know, kind of generally globally there's an insufficient, you know, availability of housing. More specifically or more nuanced would be things like student housing, senior housing, co-living, everything in between. So, you know, kind of tracking the demographic trend of, you know, need for more housing. Second, what supports that? It's logistics and it's retail. You know, the retail needs to be in reasonable proximity to the housing, and then the industrial and logistics has to be in reasonable proximity to support both the retail and the housing. So those are getting the biggest inflows. And I think your earlier point, everything seems okay. I think there's a growing concern among investors, not that funding new logistics is not a good thing, but that it may be, you know, too much too soon could prove to be a bad thing, because there's been an awful lot of capital that's been allocated. And I think your earlier point about, you know, people buying awful looking warehouses in Romania, I think there is a little bit of a concern that could get out ahead of you know, the fundamentals bit. And so, but investors are, you know, they're staying the course. I will say that if we come out with something different, there's a huge amount of demand. So differentiation continues to be, you know, kind of key element. I got plenty of offices, and I don't want to talk to my board about retail. You know, what else is out there?
I'd love to just dig into one thing in terms of the risk appetite. And where are investors generally, this is a very broad brush, probably look to the American investors, the US investors, how much risk are they willing to underwrite in terms of their own commitments? How much risk are they willing to commit to at this point in the cycle?
I will give an answer that it's different than what it would have been sort of 3 months ago. Most investors coming out of the financial crisis felt they had too much risk on. And so they were allocating capital away from development, opportunistic generally. They were looking for longer dated capital. And starting around mid last summer, we started hearing from investors, we need to put risk on the portfolio. All of our developments from 5 years ago that we thought were going to destroy us have stabilized. They're now cash flowing, income producing. We're generating enough current return that the CIO's not knocking on my door every quarter saying, you know, what's real estate contributing to our liabilities? And fixed income is providing somewhat better returns. So we did see I don't want to say material shift, but move away from core up to higher risk strategies. So some people are kind of leaping over value add and saying, I need some really long dated strategies because, or I need something that's going to really juice the returns from real estate versus I am looking for a 5% distributable yield in perpetuity. So I think that's a fairly important shift last year.
I have a different perspective because my portfolio, the core data and portfolio, is part of a multi-asset class portfolio. So it's really, my clients are public clients, they are target date funds. So for them, with the equity markets going down, it's great to have the stability of income. In fact, in Q4, equity markets went down and real estate went up. So that's a completely different market, it's the defined contribution market. So now that they are investing, and I think that's an exponential market in the US, which is probably not included in your research. Completely different market, it's just opening up now in the US. And we were, in fact, in Wien, we were the first to have a multi-asset class target date fund to invest directly in real estate. It's a 90/40 Act investment fund investing in real estate. So that's a different perspective. But right now, as I told you before, in addition to that, I'm we have raised that money on the core side, right? We have raised so far 1.5 billion. We have invested 1.5 billion. We do have a benchmark. We do have the MPI benchmark, and core is doing quite well, in fact. We're outperforming the benchmark by 200 basis points. We did 8% net return after all fees last year, so they are pretty happy with that. So we are now raising a New York property fund, value add, and I have just started the roadshows outside the US. First one, Germany and Switzerland. I just see the most difficult question is the cycle by far, the cycle, where we are in the cycle. And it's a fund that we want to raise $1 billion, so easy said, right, in 1 year? Yes.
So the size of the term of the fund?
It's 10 years. It's a holding period of 10 years, and we have an investment period of 4 years.
But I guess it maybe follows the answer as well about the cycle.
Yes, sure. That's what we're thinking. So, and we are partnering with Taconic, which is a local operator. We are certainly, perhaps people don't know about, we are investment arm of TIA, so we have 125 billion of real estate assets under management. So it's quite large, but we are not vertically integrated, we don't have property management. We are really core investors, core plus, so we wanted to have value add experience in the market. So we have been working with Taconic, which is really well known in the market here. They know a lot of families, so we partnered up with them to raise this fund. So I started January going out, and by far that's the most difficult question to answer, the cycle.
And how much risk are the investors that you're talking to? What are they willing to take? What are they willing to do?
So here's the good thing. So I have already one German investor. So $60 million is signed. So that's good because certainly the hedging cost 350 basis points. Anything below 10% return, it's not going to work for the Germans. So we are targeting 15% net, and we have a track record of 44% over 20 years, so pretty reasonable. I do think it's not easy. By no means is easy, but we do have some foreign investors interested. We are starting to have South American, that's really very interesting. Asian, I don't think that they would invest in a fund unless we have a first closing. and a property there. That's what I'm seeing. So we are targeting really Europe and South America. And certainly we're starting to target, in the US it's interesting because to your point, I think the large institution and what is happening is that because they are part of multi-asset strategy, equity markets are going down, alternatives are going up. We have a problem investing in real estate. So I do think that our best really alternatives, foundations and endowments, but we're just starting to open the market.
Bob, I just wanted to pick up, and this kind of goes to the risk thing. You didn't talk about development in some of your slides, but
right.
How much risk are people willing to accept in the market at this point of the cycle? I was just wondering if you can just kind of bring in the property transaction view as to where are people putting their money and how much risk?
Well, in the U.S. development is, peaked in 2015 and is kind of flattened out. Actually, it's off a little bit. So, we're not overbuilt. We're not in danger of it. There's certainly some pockets. I would argue hotels in Manhattan potentially, and things like that. The surge that was mentioned earlier in forward sales, which previously had been mostly a European type structure, is just surging in the U.S. as well. We're noticed that, so it's a way for somebody to get a little bit better return through development, but not the same amount of risk. The one thing I will say about risk overall, and this is a little bit at a higher level, is we see it across the globe, and all our institutional clients, they are very heightened and attuned to risk. And that's one thing that gives me comfort, that wherever we are in the cycle, we're not in a bad place. I mean, you look back at all the other peaks and cycles, it was investors and lenders ignoring risk. And, I see both the debt and equity markets being very judicious about how they're pricing their money and their risk, and very attuned to the risks out there. So, there's certainly exogenous factors and greater macro things, but I don't see the end of this cycle anytime in the near term that, it's going to be caused from inside the real estate investment community.
Bob, I think you're making a great point. The known risks they're really attuned to. And I would say the known risks are the ones that typically bring a real estate cycle down. What I have observed, I think, and I don't think I'm alone, is that if you throw a technology wrapper around a more traditional real estate investment, I think a lot of risk gets waved through. And to me, the risk in the market is this kind of general belief that technology is going to somehow lift values, whether it's operationally or in finance, and that to me is, I think, a little bit of the risk in the market. I don't want to pick on WeWorks or anybody in particular, but kind of this kind of new economy real estate wrapper that gets put on a lot of real estate. It may cover up some of the unknown risks that people ought to be thinking about a little bit.
Yeah, the whole prop tech space is very interesting, and I would agree. It's listen, we've been investors in that space. I've invested in that space, and but I haven't in the past year. It's really, if there's a bubble, it might be there, but there's tremendous opportunity as well.
I mean, one thing that was actually in your report, and you'll get the slides on this, but you had a quote from one investor that was, it doesn't make sense to put new capital at risk today.
Well, the other thing that has happened, and this is important because you think about what legislates people's behavior, and a lot of it is economics. So how do I get paid? So you have a lot of investors who, post-financial crisis, have now evolved to some more incentive-oriented compensation structure, and it's working. It's working so much that some of the large, especially U.S. public pension funds, are watching their allocations decline because they sell, and they don't see anything which, from the real estate officer's perspective, is going to be accretive to the portfolio. And accretive, if it's not accretive, it's flat or dilutive, and if it's dilutive, they make less incentive compensation. So it's working, but it also may thwart the overall goals of an institution, which most CIOs will tell you, manager selection, deal selection is interesting, but allocation and reaching allocation is going to drive the total portfolio return.
On the risk points, I wanted to add something, and where we see, because we very often have cases where clients come to us with a deal, that the banks have shifted their behavior compared to the last financial crisis, driven very much by regulation and by regulatory cost on their balance sheet. So the lender universe creates a lot of discipline in the investment decisions as well, by simply not giving money. I used to be at Barclays Capital, and we had some Irish banks, and we asked the client then 2006-07, who else are you asking? And if they said we are asking the Irish banks and Credit Suisse and a couple of others, we just flogged in a very quick calculation because we're never going to get it. We couldn't get past our credit officer what they could. And that has changed because, and this is a positive effect on regulation, I think it has made the banks more stable and thereby the impact on the wider economy less. It's now taken up by a plethora of debt funds who are smaller and not systematically important. So it is an overall stabilizing thing that I think in a downturn will also help not to have such an extreme downturn as we had in the past.
Can I just bring in Guillaume? You said you've got your US and your Middle Eastern investor, and I would love to get the differences in the risk perspective of those investors. What are they saying to you? How much appetite are they really willing to take today?
It's interesting because, well, obviously I'm more on the value add segment, but the good example is, because, you know, I like when it's practical, is also to join this kind of political sense we're all having in every country in Europe. As, you know, during this kind of yellow vest strike in Paris, as the American sensibility was, you know, how can we price this? You know, can we put a price on this? Said, honestly, I don't even know how to do it. You know, there's no formula on Excel to basically sense this. And the Middle East sense was more, well, that's good. You know, we have to buy when basically the riders on the street, and we'll be selling when those guys will be back, you know, to work, and etc.
I used to work a lot in Europe for a long, long time. When I came to the US, I said, whoa, this is so easy. It is very difficult investing in Europe because of all the different countries. We were talking about getting money out of the US. For the Americans, getting out money out of Europe is really very difficult. It's not easy.
Well,
so on a relative basis, I think it's easier for the Europeans to invest in the US.
Well, I mean, it's for the market, for sure. It's a trading market. It's easy. You can just be behind your computer. You get the broker, you get the lawyer, you get up, and, you know, if you have the money and you got a strategy, obviously, it's pretty easy. Europe is more patient, that's for sure. And you have, like, it scatters a lot of countries. It's very small. It's very tiny. You don't really understand what's going on, etc. That's for sure. But I would say for just a flow perspective, you know, getting just the money out of that country is, you know, there's a lot of friction, and, you know, the money is kind of staying out there. It's really hard to, well, from my perspective, but, you know, potentially I've been, you know, like, I need to change my lawyer. Carsten, sorry. But, you know, but yeah, just to go back, it's just to the main question is that, yeah, it's more cultural to the sense of, I would say, you know, from a American or English perspective, is, you know, they need to price. If you can price it, you know, we won't do it. We can do anything, but we need to price it. Okay? And I would say Asian is different, but, you know, from a Middle Eastern perspective, maybe there's more sensibility to taking some kind of subjective risk that can be priceable, but, you know, there's a window. There's less competition because there's this riot, or there's this political event, and there's tourism saying this. So, you know, like Alexander was doing, you know, it's a, you know, going in the city today is not crazy. Well, people say, you know, come on, you know, look at the take-up. Taking us so far so good, you know. But there's a lot of cranes. Okay, and there's maybe, you know, 3 major schemes in the city that, you know, you can see because, you know, it's there's cranes everywhere. But when you look at the project really going on, and you look at the figures, it's, you know, and the data, I think it's doable. And obviously the yield entry versus the you know, I would definitely pay a 5% in London, in the city, rather than a 2.9 in Berlin, was basically, and no offense, I love Berlin, it's a beautiful city, and I've been working over there, but, you know, when you look at the tenants, it's all, you know, Zalando, WeWork, you know, if the bubble burst, it's, you know, you're not going to get any rent from those guys, right?
Very quick question, because Adriana, you said you're literally the investors are benchmarking to the NPI. Mm-hmm. What are your investors benchmarking to?
They're family office, so they just benchmark, you know, versus all their asset class. So they can do real estate if it's sexy. If it's not sexy, they will do other things with other people that can provide them other, you know, asset classes and money.
Oh, you're gonna jump in.
Oh, I was just talking about the debt funds, which it's a new form of debt that, in the U.S. it's behind 20% of all the construction financing. And that's up from like nothing 4 or 5 years ago. There is a risk. Most of these funds are leveraged. They have credit lines from banks. Now they're juicing their returns, and I know the Fed's very concerned because that is, these credit lines to these debt funds are not showing up as real estate risk on banks' balance sheets. And we are starting to see, there's a lot of competition, so I won't say it's excessive yet, but we're watching it closely as the terms are loosening, covenants are easing. There's also the whole CLO market, collateralized loan obligations, which smell a lot like CDOs, which got us into trouble in the last cycle. So it's not a problem yet, but I'm watching the debt markets more closely for risk-taking, maybe more excessive risk-taking than the equity players right now.
One question that I did want to ask, and I'm sorry to jump around, but just what do you see, what are you underwriting? What's the biggest risk that you're underwriting in terms of your own deals and your own kind of portfolio? So, Adriana, I'll throw it out to you.
Certainly rental growth, that's the key. We were talking about industrial before. Industrial is really very difficult to source, but it's really doing still very well. Last year it did 14%. It's really a high number. But there's still rental growth in industrial, that's the reality, but we are being much more cautious. The supply, there's not much supply, it's only some markets. But even in other sectors, if you go to the multifamily sector, there are some market that has some oversupply, but I can see a lot of money coming to multifamily as well. We're trying to be cautious on rental growth, and certainly we do as well. We do a couple of things on multifamily, urban and suburban. We're suburban, we have large properties, 400 units plus, where we do renovations. And renovations in these units is starting to get much more expensive. Labor costs going on, material costs going on, so that we see the spread cost because we try to increase rents as we renovate. That's the value add aspect of the investment, but that's starting to shrink. So we're being very cautious there as well. And certainly it's the same thing for retail. It's the CapEx, and we are trying as well to be very cautious when we're investing in retail. We still invest in retail. Our portfolio is doing relatively well, better than the market. Well, for my portfolio specifically, because we have a portfolio manager that do malls in our company, but I do grocery anchored urban retail. Defensive is really urban retail in the best location, never compromise the location. We have one of the buildings, as an example, here in New York is 10 Madison Square, Flatiron District. So you see New York, all the retail markets in New York, they're going down. That's the only market where rents are going up. So we're being very cautious, and I think you cannot compromise the location right now.
Guillaume, one thing that you said before was you raised the risk of too much capital in the market, and there's too much equity coming in. Is that one risk for you? What are your kind of biggest risks when you're underwriting your deals? What are the biggest risks you're seeing in the market?
Yeah, competition is a risk, but if you want to face, I would say, less competition, you got to go a little bit off-road. So basically, targeting maybe mid-sized assets, so in a range where private capital and large institutional wouldn't so compete. But once again, it's easy to say, it's really hard to find. And really go to those kind of assets where there's a lot of work. Once again, and I would be happy to catch up with other people on that. Is I've been working for 15 years in large institutional, and maybe I'm wrong, I don't know, but doing value add or opportunistic from an industrial point of view in the big asset managers of the world, it's not happening. I've been trying to do this. You can do it, but you're more surfing on the market than anything else. So when you want to really do value add, you can make money. Not just by surfing, the real value and money you make is by getting the tenant out, getting some reversion, putting some capex, turning around the building, and getting every penny you can get out of the building. So I would say that the most sensible things in a business model as of now, obviously compression, you just forget about it. I forget about it. Obviously the rents, focus on an area where you can get some rent improvements because there's great infrastructure project, because whatever. get a proper financing, and you could get a lot of very good financing, especially in Europe with a lot of German lenders or French lenders or even UK lenders. And also try to make correspond the capex envelope you have to the need of the tenant as soon as you can. So basically shaping this is you can easily get some couple, I would say like 10 to 20 points of return versus the initial business plan that you have.
David, I want to bring you in just to get the perspective from the institutional investors. Where are their biggest risks? What are they looking at as they look to the market, as they look to the next downturn? What's the biggest thing in their minds?
Well, again, hard to isolate it to one. I think there's a couple of themes. One is reinvestment risk, and they have found that the capital is coming back quicker than they're putting it out, and one of my friends at a corporate fund says, it's the hamster in the wheel syndrome. He runs as fast as he can, and he never gets any further ahead year after year because the capital's coming back. So their risk is they've got capital in safe hands and assets they understand, and it comes back quickly, and they don't have the resources to really think about how to put out the capital in other ways. So it's having two effects. One, they are approaching managers as opposed to the other way around about, can we restructure this vehicle? You created all these very nice assets for us now that were all unstable when we started. Can we turn these into longer dated holdings? And I think when the investors approach the managers as opposed to the other way around, we're seeing some of these are actually getting executed. And by the way, corollary to that, there is some concern among investors. You're starting to hear that, well, everybody wants to hold assets longer. At some point, there are going to be just fewer things to buy. Therefore, it's created, in some cases, a little bit of a pricing rush to whether it's create the logistics, core portfolio, or buy better multifamily, or the live, work, play assets. There, I think, are some investors saying we got to get control of these because they're not going to be trading much in the future. And we've seen that not so much from the U.S. investors. We've seen that very much out of the Middle East and among some of the Asian institutions as well.
I think one point we have not sufficiently touched upon, when we underwrite something, rents are super important for us. In retail, we project falling rents, quite frankly, and it depends on what level they are currently and what we believe about the asset, and we let the market come towards us. The other one is interest rate risk, because that will affect the yields on exit. And if we have a look at the short 10-year bond slide I put up as one of my first ones, we are past the inflection point, certainly in the United States. And the question is whether a bond market as big as the European bond market can be suppressed by the ECB long enough to disassociate itself from the largest market, which is the US bond market. And I don't think so. On the long run it won't work, so you'll have a reversion in yields, and that'll change your pricing. And you'll have to factor this in as well. What are you going to get out of this asset at what price? Even if you did all the capex and all the investment, if the yield cycle has moved against you, you're having a problem. And if the overall industry cycle has moved against you, you have another problem. We are just now bidding on a retail asset. Just put a number, just put it a round number. It was on the market for 100, and we came in and offered 65 and promptly rejected. I think ours is the right number. The vendor has come back now, is 80 accepted? And I said, no, it's 65, we're not playing, we're just serious about it. And that's combined because we see yields shifting further, and in retail assets, the yield shift has not been recognized in the assets. Whatever they're priced at now, many of the cases, certain locations, new building, I have no particular knowledge or opinion of, I'm sure it's perfectly fine, but many of the others will go down, and rental values will go down as well. Office, most locations will be stable, unless you pick something, as you mentioned, and Thierry mentioned, an area that is growing. So those two determinants make it actually quite difficult to return more capital than you initially expended to the investors. So you have to be super careful when underwriting, and that in an environment where so much money is chasing assets. And if you're really prudent, you're never going to buy anything. So it's...
I did want to ask that question, and I'll bring in David. And in terms of, commercial real estate looks attractive on a relative basis. And so as you're seeing rates kind of go up, are we going to see investors kind of pulling out of real estate that may have just come in because yields were so low? I was just wondering, in terms of that, Bob, you looked at the spread between commercial real estate yields and the risk-free rate. Are we going to see some investors pull out of commercial real estate because obviously the rest of the world, or at least fixed income looks a little bit more attractive? Does that make sense? Or?
It makes sense, and the answer is it depends.
Yeah.
So why are interest rates rising?
The stickiness of the investors.
If it's, rates are rising because, we're having great, employment growth and, good GDP growth, that's a good thing. That's naturally spreads should compress during periods like that. My belief, and we saw it here in the U.S., and we saw the interest rates rise over the past year, and of course they came back down, as well. It's been a bumpy ride, but there's a lot of spread, a lot of cushion in there. The lenders absorb some of it. Quite frankly, I think the market, probably here and in Europe, has been pricing in higher interest rates, knowing that they're artificially low. So, there's some give there. I mean, the spreads I showed are abnormally high compared to long-term averages, especially during, periods of economic growth. And one of the first mechanisms we see is just simply transaction volume slow. Becomes a little bit of a disconnect between buyers and sellers, and that's immediate reaction. So there's a lot of cushion before prices will start to give and cap rates rise. And we saw here in New York, it only took about 25-30 basis points rise in cap rates for stuff to start trading again and buyers and sellers to get aligned. So it may not be such a big price correction, with...
But 25 bips of 4% is a lot of money. 25 bips of 8% is negligible.
Right.
And we are now closer to 4 than to 8.
Right.
But
Especially if you're levered.
Yeah, just one thing, and sorry for the metaphoric thing, but it's going to be a bit harsh. But the situation in Europe is like Europe is all of Europe is addicted to debt. I won't say the U.S. not especially the U.S. And how do you cure someone that is addicted? It's easy. Either you keep on drugs, so this is called ECB, QE, okay? Even if we don't have more QE, we will remain as it is. Or, what do? You take the addicted guy, you put him in a room, you lock it, then, you let it go. And no one wants this, because, if we do this, every day we're reading about Deutsche Bank, about a lot of things, so I think it's going to go for a certain amount of time. And, we're going to be under perfusion for a long time, so obviously, we won't expect any compression once again, sorry for repeating. But there will be other way of value creation. But I don't see the ECB doing anything crazy, because when we will look at the figures as of now, no one is doing well. UK Brexit, Germany slight slowdown, Merkel question mark, France, well, we have the yellow guys on the streets, Italy okay, Spain, Barcelona, Madrid. So Poland right wing. So you don't want to do anything crazy.
This is not a marketing.
I just wanted to say, exactly.
So on a relative basis, the U.S. is much better than everyone else. That's the reality. And you're seeing already the market changing, and already when you go back to 2015, 2016, mainly primarily Chinese investors, if you take a look at the numbers, there has been a really big change. They're investing regardless of yields. So that has changed even in New York. So it's all much more here about as you were saying before, about the smart money. So you're starting to see a shift already in the market. I don't expect a bigger shift. And specifically New York, I think the market is much more diversified than you have seen in the past. You have Cornell, you have Amazon, you have Google, 12,000 jobs more. So really diversified. So I expect the rents to decline a little, but not as much as in the past. That's our view.
Well, I'm going to wrap it up because in terms of time, there's many questions I didn't get to, but I do want to ask literally Adriana, Bob, and David in terms of your number one property type that you'd invest in today in which market? So Adriana.
Oh, New York.
Oh, you never found it?
Which property
New
type?
York, I would say office. Interesting. Condo disruption market. That's really very interesting. Condos is very expensive in New York, but you can see a disruption there in the market, so we're looking at that as well.
Bob, I know you're not investing money, but what would you do? You've got the data. You've got the data.
I think some of the medical office is really attractive on a yield basis. And we're seeing a lot of people going to niche property types. I think that's one that's still a winner.
Markets?
You can never go wrong with Manhattan. But you know, the Texas markets, that's where people are moving to.
David, you're working. You've seen a lot of what the
No, we
investors
are,
doing,
and
so-
which client will I offend by? I would probably advise a barbell approach, do something really straightforward, and that might be, you know, maybe overpay a little for some of the best logistics and the best locations, and you know, I don't want to go market by market, but you know, I like places I can drive instead of fly, so that would be in a metro area. And I think at the other end, I would be looking at probably more nuanced investment in the senior housing sector. And I do like medical, but less the medical office than the office that is really part and parcel of life sciences, big pharma, lab space, where people are actually either partnering with pharmaceutical companies or with universities to establish high-quality research facilities, because there's hardly any, and that is going to be a drag on growth in that sector. So I would go for barbell at this point. I don't think there's any one that's going to win the day.
And I know Alexander and Guillaume, you've given a lot of your opinions, but quick property type market.
I mean, it's, you know, development is still per deal, so it's still driven. But I would say, you know, go for complexity for the asset. And that's it.
Alexander.
Only value add where you believe that on a 3-year perspective you can shift the asset by more than any yield change will hurt you.
Fantastic.
Can I make one last comment?
You can.
Sorry, I didn't mean to. I wanted to say this earlier.
That's okay.
I think that the most thoughtful investors are saying value add's great, but why do we always sell the assets? And why? Because somebody needs to get paid to promote. So I think a lot of investors, if I were to say, you know, what ought you be doing is improving your own assets, and don't be so quick to sell them, because once you've got them, it's you know, the devil you know, the asset you know is better than the one you're hoping to find around the corner.
Thank you very much.
Great, thank you.